Then what we have to do, though, is have a plan for if taxes increase. So the planning just changes. Your tax rate today is this amount. We know what the tax rate is. We don't know what it's going to be in the future. So we're going to base your plan on this tax rate, but we're also going to put a contingency in here that in 10 years from now, 20 years from now, whatever it is, your tax rate goes up. Here's what we're going to do. The bottom line is everyone needs a plan for any of these, things to happen, converting or not converting.
Hello, and welcome to Simplify Your Retirement with Stephen Strickland from Wise Wealth. Good morning, Stephen.
Good morning, Paul.
Today's going to be a fun episode. I'm really excited about it. As I was prepping for today, I was thinking about Benjamin Franklin, and I know there's a quote from him that you always use. And what's that quote?
Yeah, Benjamin Franklin always says, an investment in knowledge always pays the best interest.
Yeah, yep. I mean, he was very well known for a lot of great sayings.
Yep.
Another one that is attributed to him that actually started with him was, there are only two things certain in life, death and
taxes.
Taxes.
That's right.
And so that's our subject for today is taxes.
Yes.
And taxes this is one of the areas that we cover when we talk about planning. We've been going through the season talking about the different areas of a plan that make up a plan. And last time we talked about insurance, and this time we're going to be talking about taxes. What are the 6 areas, or 7 areas really, the 6 core areas of planning, and then the 7th overarching area that we're talking about this season?
So obviously this season we focused on having a freedom plan, the freedom to give, serve, and enjoy life. And so in order to have freedom, which is, sometimes we refer to it as the 7th area of planning, but it really comes into play once you have these other 6 already in force. And so far this season we've covered, I believe we've covered 4 of them already. Today is the 5th one. And so the first area is what we call income planning. Income planning covers liquidity planning, income planning, and investment or growth planning. And it's really where we start. If someone's going to have peace of mind for retirement, if someone wants to have freedom in retirement to give, serve, and enjoy life, we know that they have to have the foundation first. And that is, they need to know their income is secure. They need to know their investments are invested properly. They have the assets they need to cover their expenses in the next 3 to 5 years. All the things we do that I would just say that a lot of times general financial planners will do, liquid income and growth planning. But then we said we want to take our clients to go beyond that. And going beyond that means impact planning. We want our clients to be able to make an impact. And making an impact means being free to give, serve, and enjoy life. We do that by planning around insurance. We had a whole episode about insurance and, life insurance, long-term care, Medicare. There's transferring the risks, that we can to insurance companies. That just gives peace of mind and, freedom. And then today, tax planning. This is a huge, huge topic for our clients. It's one of those areas that people tend to be very concerned about. And then the other area is legacy planning. So I know we'll get to that sometime soon. And then once you have liquid income and growth, you have tax, insurance, and legacy. You have a plan on how you're going to deal with all of those concerns, deal with all those issues. Then you really can be free. You have an answer for each one of these things. And so when we typically do, surveys for our clients, we'll do a seminar, we'll do a workshop. And a lot of times we'll ask people before the workshop starts, what is your number one concern going into retirement? A lot of times the number one answer is taxes. People are worried about what taxes are going to do because it's one of those things that literally, we have no control over. Someone else is controlling what that number is going to be, and that's a fearful thing. And it's something definitely that has to be planned for, just like anything else that is unknown. That's what planning is all about. It's always planning for things that we don't know if it's going to happen to you or not. But the best way to be prepared is to say, I don't know if this is going to happen, but here's my plan for if it does. Yeah.
And I know when we do classes and things, you always ask people, with the debt getting so high, do you expect the government to spend less or to tax more.
Right.
And I mean, without question, everyone says tax more. I mean, they don't expect the government to spend
99% response rate. People think taxes are going up. How many of you guys think taxes are going up in the future? I've never had anybody say, nope, I think they're going down. It's never happened. So.
Yeah. And so for today's episode, we have someone with us today who's a little more of an expert than you and I in this area.
Absolutely.
Who do we have with us today?
So I'm happy to introduce today on our podcast for the very first time, Becca Ollar. Becca is our CPA here at our firm. We're glad that she's on our team. She is obviously a CPA, but also a tax preparer and a tax planner. Becca.
Hi, Stephen.
Welcome to the podcast.
Thank you. Happy to be here.
Glad you could join us today. So how long have you been a CPA?
I have been a CPA since 2018.
2018. That's awesome. What I appreciate about Becca in her experience is that there's some people who are CPAs that work in a tax office.
Right. Some
people are CPAs that work in, accounting firms. You're a CPA that has gravitated towards financial planning firms. What would you say is the difference between a CPA that works for an accounting firm versus a CPA that works at a financial planning firm?
I think with a financial planning firm, we're focused more on planning for individuals, whereas a lot of times accounting firms, they're not focused on the set individual. They're focused on more so business returns, corporate returns, anything like that.
Okay.
And that's my background has always been in financial planning, even before I got the actual CPA exam passed. That's what I did before then.
I know you were an aspiring financial advisor, I believe, at one point in time.
Yes.
And you changed your mind to accounting. It's amazing to me. I never, wanted to go the other way. So financial planning for me, accounting for you, that's awesome. I think in these CPA firms, these accounting firms too, it tends to be a lot more kind of behind the scenes.
Right.
CPAs with a computer and a closed door, quiet, not seeing anybody, not talking to anybody.
Yes.
It's different in this context.
Very different, because a lot of times, if you're just at an accounting firm, people are just going in, dropping off their taxes and documents in February, picking them up in March, and then they don't talk to their accountant again until the next year. Right. I'm constantly talking to our clients here. I want to help them plan all year long. There's always tax questions, and things are continuing to change, especially if you are getting into that retirement stage of your life.
Exactly. And that's what I appreciate about you, that you are relationship minded. It's unusual, Paul, in this industry to find a CPA tax preparer that is concentrated on relationships, that they matter to you in helping people get where they want to go. Another one to me is, generally speaking, there's a lot of people who have tax preparation services, and they tend to find out from their CPA or tax preparer what they should have done. Okay. I did this for years. I'd go there and they'd say, okay, well, if you had done this, that, and the other, it's like, well, I wish I had known. And so there is looking ahead. There is talking to clients and saying, here's what we can do before December 31st. Here's what we can do before April 15th. It's not just data entry. It's actually being a partner in helping them, minimize their taxes.
Right. Like I'm a partner with you. I'm a partner with our other advisors here. They're able to tell me what's going on with a client if something does change in the middle of the year. And that's super crucial for me, and to plan ahead and make sure we're doing everything we can.
Paul, for years, we did surveys with our clients, and we would ask them things like, hey, what kind of services do you think that we should provide? And it's kind of like we said before about the clients, what's your number one concern? Taxes. What did we hear over and over and over again? What this firm needs?
A CPA.
Or you need a CPA. You need a tax planner. People were asking for it. I can understand it. It's always been a goal, dream of mine. Becca's been with us for about a year and a half or so now at this firm. Does a great job. So I want everyone to know, first of all, is, you can have a tax preparer that is proactive. You can have a tax preparer that is planning minded like we are. You can have a financial advisor that can work with a CPA, not just one that's at a different location, but in the same office. And Becca just alluded to that. We're able to, talk with her and say, hey, we met with a client this week. Here's the issues. Here's their accounts. She can go in there and look at all that stuff. And there's just an advantage of having those services combined. Having your CPA with your financial advisor, all the records, all the statements. She has access to all those things. And you're just going to get consistent advice across the board. And, that matters.
It does. And, the proactive aspect of it is what I've heard the most sitting with people when they talk about their CPA and something that's a negative experience. And I think part of it comes from the word tax preparation. People think in preparation, you're preparing for something. Well, a lot of times, unfortunately, it's a reactive, and the preparing is just preparing documents in a sense, right? It's not really planning ahead. And what they've wanted for years is a proactive approach that looks ahead. And that's what I appreciate about you, Becca, and what you bring to the team here and for our clients, because that's what it's about. It's planning ahead rather than just saying, oh, well, if you would have, well, that would have been good to know.
Right. Absolutely. And if someone is listening to the podcast, maybe you're a client of Wise Wealth, maybe you're new to Wise Wealth, new to our firm. Certainly, I just want to throw out right now, you can go to info@wisewealth. You can email, info@wisewealth, and say you want to, talk with Becca about tax planning. You can also just go to our website, wisewealth.com. Not everyone automatically knows, hey, we do tax preparation or those kinds of services. So I want to throw that out there now. Even if you're not a current investment client of Wise Wealth, she certainly can help you with tax prep. There's just a discount for clients of Wise Wealth. So today, though, I want to kind of break this down into like two broad areas. One is tax planning, and the other one is tax preparation. Tax preparation at this time of year is what's in everyone's mind. So we'll end today's podcast talking about that. But I want to talk about some tax planning. There's a few things that I know we look at when it comes to tax planning. Sometimes it's year in, it's every year what we want to do to prepare for taxes. Sometimes it is before certain ages.
Right.
Before age 60 or before age 73 or, whatever the case may be. So one thing I think it would be good for everyone to know is just, when we talk about people's tax brackets, there seems to be, what people focus on. But there's a difference between someone's tax bracket and their effective tax rate.
Right.
You want to explain that?
Yes. So when someone says you're in the 24% tax bracket, that doesn't mean you're paying 24% on all of your taxable income. It's a tiered calculation. So you're paying anywhere from 10 to up to 24%. And there's 4 tax brackets within there. And in those income ranges, that's the tax that you're paying on that amount.
On that portion. Okay.
And a lot of times, that's a huge benefit of having a CPA here, because a lot of times an advisor that doesn't have a CPA working for them is just going to have, when they're doing their calculation for retirement, is going to assume they're in the 22 or the 24%, and they're going to use that flat rate on their income when they're trying to figure out how much they need to retire, when can they retire.
Yep, that's a very good point. And so then there's also now this standard deduction. So for married filers, I guess in 2024,
yes,
going forward this year, it's not the same as last year, but for married couples, $29,200. What does that mean?
So that is taken out of your total income after that's calculated, and then from that number, after the standard deduction is taken out, that's where your tax rate is that tax rate is calculated, and then your tax is calculated.
So until someone reaches $29,200, there is no tax.
Right.
Someone makes $50,000, it's $50,000 minus $29,200. Okay. So we don't even get to the tax brackets until after $29,200 if you're married filing jointly.
Correct.
Okay. Then from there we have these tax brackets, and like for example, in the 22% tax bracket, married filing jointly, income is from $94,301 to $201,000. This is 2024. So a lot of people assume, hey, if I make $100,000 a year, I'm getting taxed 22% because I'm in the 22% tax bracket.
Right.
But in reality, if they made $100,000 a year, it would be minus $29,200.
Correct.
Then the next $23,000 is taxed at 10%. The next 90, okay, just like that. So that's why a lot of times, Paul, when we do planning, we'll go to our clients and say, hey, we're going to use a 15% tax rate on your income.
Yes.
And they scratch their head. There is no 15% tax bracket. Okay.
Yes.
Yeah, but we'll use that because we know your tax bracket doesn't mean that's the amount of tax you're paying on every single dollar.
Right.
You have an effective tax rate that we go by. So that's important from a planning standpoint. And so when we're looking at, another big thing as far as planning is concerned, a lot of people look at is Roth conversions.
Yes.
I'm one of these guys that just basically really believes in, Roth IRAs. Buy out the government now, pay tax on the seed rather than the harvest. I'd rather pay tax today on a dollar amount that I know and a tax rate that I know than a tax rate unknown in the future and a dollar amount in the future. And so sometimes when guys like me talk about converting to Roth IRAs or Roth IRAs, people get excited and they want to do it. And so they say, hey, I want to get my IRA into a Roth IRA. If someone wants to do that, what are some of the things they need to be aware of from a tax standpoint?
So a big thing I like to tell clients is sometimes all you're thinking about is the federal tax that you're going to pay on that Roth conversion. You also need to think about the state tax that you're going to pay. Sometimes that's just forgotten, and then it comes to April and you have to pay both. And sometimes clients get a little irritated, and that's just the case. And then there's also the option to withhold from those Roth conversions. Personally, I tend to tell clients not to do that just because it is an estimate. So when you're calculating what you need to withhold, you don't want to take money out that's growing tax-free, the harvest. So you'd rather make sure you have that cash to pay the taxes when we file in March or April, whenever you're ready. So that's something that I strongly believe. I know some people still do withholdings from it, and that's totally fine. You just have to know you're taking money out of an account that could be growing tax-free for you.
Okay, so you're basically saying that if someone's going to do a Roth conversion, it's going to be better that they have money set aside, let's say in cash, to pay the tax.
Correct, yes.
So one of the analysis you're going to do is not only how much am I going to convert, but do I have the money in cash to pay the tax that's going to be due on that amount?
Yes. So a lot of times when I'm looking for a client on planning and how much they can convert, I look at what tax bracket they're currently in, and I max that amount out. But then you have to look at the tax bracket. So there's a big jump from 12 to 22, and then there's a small jump from 22 to 24. So if they're in the 22%, I don't think it's a huge deal to move up to the 24% tax bracket. So I'm going to look at that. And then I'm also sometimes clients only have, let's say I want to pay $10,000 in tax this year. I don't want to pay any more than that. I'll back into that number for federal and state to figure out how much they can convert and pay $10,000 for the year.
So it's good. So when someone's looking to convert an IRA to a Roth IRA, another consideration is that going to move you into a new tax bracket?
Yes. On
that portion that's above that new threshold.
Correct.
And of course, we just talked about how the only thing taxed to that new number is anything above that threshold.
Right.
But going from 12 to 22. So one is it going to move them into a different tax bracket? Another one is how much money do you have set aside to pay tax?
Right.
And then we can go backwards in the number. This is how much you can convert.
And then another one that I like to look at too is the client's age.
Okay.
So one thing that you have to think about when you're converting, if you're 63 or older, is the IRMA limitations and paying Medicare premiums if you go over that limit. So there is a limit I look at to make sure that the client won't have to pay those extra premiums. Obviously, it's a 2-year look back. Paul can talk more about all of
we have a Medicare expert on the on the podcast with us today. So very important. These are good considerations when thinking about IRA to Roth IRA conversions. Another one is before age 63. So Paul, a lot of people don't realize, they think, hey, wait, what do you mean? Medicare starts at age 65. Why are we talking about 63 when it comes to whether or not you convert IRA to Roth IRAs?
Yeah, so 63 would be the starting point for it. Technically, it'd be 2 years before you start Medicare because IRMA is always looking back 2 years. Okay, and it has to do with because of tax filing extensions, all of that. 2 years is what they're able to look at any point in time. So that's why it's a 2-year look back. But it is a big consideration when you're doing Roth conversions because it can put you in a higher threshold, which means you have to pay more for your Medicare Part B premiums and Part D premiums, and that's per individual. The problem is a lot of people don't realize it because it is a 2-year look back. They convert this year. They pay taxes next year, and then another year later sometimes, then they get the surprise from Medicare, and so it's like the gift that keeps on giving.
I mean, sometimes it still is beneficial to do it, even if you do go over those limitations. But sometimes, 2 years go by and they forget, and then they're a little irritated, which is understanding, but it's still to the benefit of the client.
Everyone just needs to know after age 63, if you're going to convert any amount of your IRA to a Roth IRA, there's the potential that your Medicare premiums are going to go up 2 years later. You know what I mean? Like you're saying.
Yes.
So you have to remind them of that, but they just need to know that. And so as a financial planner, sometimes we look at this, and Paul just alluded to this a minute ago, and that is we may say, hey, it's still worth it. You may convert your IRA to a Roth IRA. It may trigger this, monthly adjustment amount to your Medicare for 1 year. In that 1 year, it'll revert back to the amount that it's supposed to be after that. So someone could, bundle all these, conversions in 1 year, take the tax hit, also take the IRMA, the Medicare, premium hit. And take that, Medicare premium hit for 1 year. Maybe they end up paying $200 a month per person more. Let's just say, as an example, you pay $5,000, for a year, for 1 year. Someone might do that because they're more worried about the tax rate going up.
Right.
They're more worried about, paying taxes at this low rate, paying a little more for Medicare for 1 year instead of having their taxes skyrocket. So it doesn't mean that you shouldn't convert just because IRMA is going to happen to you.
Right.
Right?
I agree.
It just means you need to know what it is, like everything else, and then say, okay, I know this is the reason why I'm converting. I know my Medicare premiums are going up in a couple of years for that 1 year. But like you're saying, that's another key consideration. And this is great because these are all the considerations people need to think about when we want to convert IRAs to Roth IRAs. The good news is that you can. A lot of people have all these old 401ks. They have these IRAs and they think, man, I wish I had a Roth IRA. I'm stuck. Well, the good news is you can move that to a Roth. You just have to pay the tax on the way over. You'll pay tax now, but never again. Not only on the amount that you paid, but also on any of the earnings going forward, as long as it's been there 5 years, 59 and a half. Right. One other age I think is important when we're looking at conversions is 73. So we think of 63 and 73. So 73 is obviously the year now that everyone has to take required minimum distributions. So from a financial planning standpoint, a lot of times we'll tell our clients that the goal would be to have all of your monies out of IRAs into Roth IRAs by age 73.
You read my mind because this is what I was going to say next.
Okay.
Yes.
All right.
Yep.
Yeah. So why is that a big deal?
It lowers your required minimum distribution amount. So if that's something you're worried about and you don't need to take those required minimum distributions every year because you don't need that money, you have it coming from somewhere else at 73, then put that in a Roth IRA
You're
so you
saying
don't have
there's
to.
no RMDs in Roth IRAs?
Right.
That's right.
Huge
That is
benefit.
a big deal. Paul, we people all the time, man, they get to 73. They don't want the money out of their IRAs or 401ks. They don't need it, let's say, per se. They're forced to take it.
Yeah.
The reason they're forced to take it is because the government has not been paid their, quote unquote, fair share. The silent partner who's been waiting for you, in letting you take all the risk, letting you invest all this money, and they've been waiting for you to take this money out and share with them. You're not doing it. And at age 73, they're saying, we've waited long enough. And so they make you take a certain amount of money out, and it's because they want to be able to get the tax portion of that. And so not only do they tell you how much you have to take out, they also tell you how much of that they're going to take. It's called the tax law. So they can decide at any point in time. So I love the idea of converting IRAs to Roth IRAs, eliminating that concern.
Right.
What I said at the beginning of the show today, buying out the government, doing it now and getting it over with at a tax rate and an amount instead of an unknown amount later.
Right.
And so, and ideally by 73, because then at that point in time, you don't have to take required minimum distributions, or hopefully you've eliminated a lot of them.
Well, and also for if someone were to inherit that traditional IRA, they're going to have to take required minimum distributions. If they inherit it as a Roth IRA, there's no required minimum distributions, and they also don't have to pay tax on it.
Yep. Huge. And so, that's a big deal too. If your kids, what would your kids, we ask clients this in our classes, what would you rather inherit, an IRA or a Roth IRA? The answer is Roth IRA, 100% tax-free. Now, on the traditional IRA, if it's a non-spouse, they have, it still has to be, totally withdrawn within 10 years. Same on the Roth. The difference is it's 100% tax-free. That's the difference.
Yes.
Which is huge. So, again, you'd rather inherit Roth IRAs. And Paul, we have gone into this. We cannot go into this right now.
Yeah.
It's a rabbit trail, but taking RMDs, buying life insurance, that may be a time for another show.
Yeah, that'd be another show.
Okay, we don't have time for that.
Yeah.
Okay.
But I will say, though, that, and this is where planning comes into play, right? Because these are all individual topics in a sense, but yet they're all related. right? So someone might take an IRMA hit for 1 year and convert so that they don't have RMDs, or they lower their RMDs because when they hit 73, their RMDs will push them in their IRMA every single year.
Yeah.
Right. And so when we're looking ahead, so we have to be forecasting in a sense and thinking through all these aspects. Yeah. And that's where working with a trusted financial planner and a CPA, when working with Wise Wealth, where that comes into play is that's what the planning is about, rather than just making a single decision. I mean, what's the principle we go by? No investment decision outside the context of a plan.
Absolutely. All of it is done with planning. That's why it is so important, like you're saying, to have a team of professionals, financial advisors, CPAs, tax people, where we're planning these things out. There's a lot of things out there that you do need to be prepared for. And sadly, age 63, age 73, this is not the time that people want to be dealing with those kinds of things or any surprises from a tax standpoint. So it is important to work with a team of professionals that can help you plan for these things. Paul, you brought up something that came up while you were talking about it. Another thing I had on my mind, and this is an interesting one. I got to ask Becca about this, because there's this whole idea of no tax. Zero tax. So if someone had a IRA distribution of $29,200 married and filing jointly, that's part of the standard deduction if it's an IRA distribution. So someone theoretically, if we really wanted to go crazy with planning, we could say make sure your RMD is $29,200 or less. Okay, because if it is, technically it wouldn't be taxed. If, let's say, all your other income was tax free.
Yes.
If you could do it perfectly. I know it's almost impossible, and you're looking at me like,
especially with the tax laws changing, because that standard deduction is going to go away.
But I know, Paul, there's people that teach that.
Yeah.
Keep enough money in IRAs so that you get that standard deduction, whatever. So that is a thing you can do. Yes. The whole point is there's planning around this. So bottom line is, for people out there listening to the podcast, and that is you've got to have a plan. You want to have freedom. You know what I mean? You want to have confidence in retirement. You want to be out there giving and serving and enjoying life. The last thing you want to do is, being worried about IRMA and, the government raising taxes. Imagine if all your accounts are tax free. The government can do it. I mean, you're out there doing what you want to do, and that's not a concern. If someone doesn't convert, or they can't, because you said right at the beginning, you got to have the money in cash to pay the tax. So sometimes people hear this and they think, oh man, I'm really in trouble because I don't have the cash to pay the tax. All my money's in qualified accounts. And Becca, the CPA, said you shouldn't, pay the tax on the IRA. And so, but it's not the end of the world.
No.
It's not the end of the world. So Paul, they're still paying for those people. Just because you can't convert doesn't mean, there's a method to take the money out. Then what we have to do, though, is have a plan for if taxes increase. So the planning just changes. Your tax rate today is this amount. We know what the tax rate is. We don't know what it's going to be in the future. So we're going to base your plan on this tax rate, but we're also going to put a contingency in here that in 10 years from now, 20 years from now, whatever it is, your tax rate goes up. Here's what we're going to do. The bottom line is everyone needs a plan for any of these, things to happen, converting or not converting.
Yeah. Is it the rule of 10? Is that what it's called? So if you withhold from your IRA, your Roth conversion, the rule of 10, it's okay to withhold if you're not going to touch that money for 10 years.
Absolutely. I like that. I've never heard it referred to as the rule of 10. There's a lot of rules in my mind.
Or rule of 5.
Yeah, we have the acronym rules, but I agree with this.
Okay. Because your money is going to catch back up by that year. You're going to end up with the same exact number tax-free if you can do it for 10 years. So what Becca just said is important. I'm okay, because I'm not a CPA. I'm okay with paying the tax out of the IRA conversion, when you're doing the conversion out of the IRA, if, like you just said, you have no plans to touch it for 10 years. Then it's okay. If you're going to convert it and use it right away, so no. But then there is a reason why you can do that then, as long as it's 10 years. So I appreciate you bringing that up. And if I know some clients that are going to be listening to this and they want to do a Roth conversion in July and withhold. I would strongly suggest against that because we don't know what the income's going to, sometimes things change, right? So if you are going to withhold, let's wait until December and get an exact calculation of what your taxes can be. So you're not withholding too much and you're putting as much possible as you can back into that.
That's
Roth.
great. So if the taxes coming out of the IRA, wait till December to do that conversion. That's awesome. This is great advice, great information. So tax planning, a lot of it today, centered around the tax rate, the tax bracket, what your effective tax rate is, IRMA limitations, Roth conversions. Now, in the time that we have remaining, just want to talk about tax preparation.
Let's do it.
And so, as we're recording this podcast, it's January, so a lot of people are thinking about tax returns and that kind of stuff. And so, when it comes to tax prep, some people are do-it-yourselfers. Hey, we've got people, Paul, that think that, hey, if I do it myself, when it comes to investing, I'm going to save money because I'm going to do it myself. When we find that the actual quantifiable results are you don't save money. And this is not theory. This is quantifiable research done that says the people who do it on themselves who are saving the 1% fee, a lot of times it's costing them a lot more in returns. Would you say that relates to the same people who say, I want to do tax prep on my own because I don't want to pay a fee?
I do. I think there are a handful of people that can do it themselves, but I think after a certain time, you need to be having someone do it for you. And it's smarter to also stay with the same person year after year. So they know your situation, they know how to get a hold of you, they know what tax documents to be looking out for. And like if you're getting your taxes done here and you're a Wise Wealth client, we have information from our brokerage account, our brokerage service that we use, as well as any annuities. So it's just easier.
You don't have to chase this stuff down, get statements, you have all that stuff here.
Yes.
So being consistent, using a CPA. I know sometimes we've talked about, some people might be afraid to pay a few $100s, but what happens if someone does it on their own and there's a mistake?
They're going to end up paying penalties and interest to the IRS and the state. Also, a lot of times if you have to amend a return, that is a cost out of your pocket, and then it's also more expensive to go hire someone to do that amended return for you.
So, we believe you should, have a professional help you do your tax return. There's no reason not to. Becca's a CPA. She can sign off on that return and represent you in that return. And so, it may cost a few $100s to get a tax return done, but it's the cost of peace of mind.
Right.
Not wondering, did I make a mistake? Because if you make a mistake, that's costly. So it's almost like an insurance policy. Hey, I came in, I had a CPA look at my return, and but also when you're doing returns, either you're going to do the return or not.
Right.
Right. In other words, you're not just going to. I'll review your return for you and see if you did this right.
Right, because reviewing a return is basically doing the return. And a lot of times people will ask me or say, I don't want tax services, but I'm going to prepare it myself and ask you questions. And that's just something that's a liability and that we don't do, unfortunately.
It's too much to go through that, and you can't say yes or no to these things without doing it. And you can't, from a fiduciary standpoint. So we would just recommend, just like with financial planning, just like with insurance planning, just like with, financial advice, investment advice. There is a world out there of AI. There's a world out there of robo advisors. And what I always like to tell everybody is robo advisors have a brain, but they do not have a heart. And you may be able to go to some online, tax preparation thing. They have a brain. But they don't have a heart. We have someone here who has both. She has a brain, she has a heart. She's going to, find out what you need, what your goals are, what your plans are. That's better. That's better tax preparation. That is better insurance. It's better peace of mind. And so for people that are listening to the podcast today and they decided, you know what, I want a CPA. Not only do I want a CPA to do my tax return, I want Becca to do my tax return for me. Doesn't matter what state they live in.
No, it
doesn't matter what state they live in. And, what would be the best way for them to get in touch with you to say, hey, I would love for you to do my tax return? And then what would you want from them? What do you need from them?
I think the best way is to call our office, 816-246-WISE, or send us an email at info@wisewealth. And then from there, what I normally do is I look at your prior year return and give you a quote based off what preparation needs that you have. And then you'll send in your tax documents. We'll get it prepared and schedule a meeting.
Awesome. And Paul, I'll give a shameless plug for clients of Wise Wealth. If you're an investment client of Wise Wealth, you're paying a fee for financial planning advice. You're also, that fee includes tax planning. But to get your tax return done, that's a different thing. But we do have a discounted fee for anyone who's a client of Wise Wealth to get their tax return done through Becca. If you're not an investment client, Becca can still do your tax return. You just pay the regular fee. Becca, anything else you want our clients to know, our podcast listeners to know about taxes or anything like that?
I don't think so. Okay. It's going to be a busy time of year here in a couple weeks. So
we caught her,
I am looking forward to meeting our new clients this year.
Thank you, Becca. I really appreciate it. I know this is going to be a busy time. Once again, we caught you right before the busy time starts. And so thankful to have you on this team. You made a big difference. Our clients appreciate you, everyone who works with you. And so we're glad to have you on this team. What you provide for me and the advisors here and our clients, it's been great. So thank you. And Paul, tax planning, tax preparation, it's obviously top of mind for people. And I'll just go back to what we said at the beginning, and that is we want people to have confidence in retirement, a simple retirement, peace of mind in retirement, freedom in retirement. And one of the ways you're going to have that is by making sure you have a plan to deal with one of the biggest risks we have, and that is taxes.
Yeah, absolutely. And you've touched on it throughout this episode, but taxes a lot of times come across as impersonal because we're dealing with numbers, right? It's numbers. And there's laws and there's changing laws and there's how does this work and there's rules to play by. And a lot of times it can become very impersonal. And so that's why people also think, hey, a robot's okay because it is impersonal. But it is personal because this is a piece of your overall plan.
Right.
This plays into everything that's done. It's not just by itself. It's everything together. And, and it's very personal. Becca, you mentioned several times that people get upset Man, when people have to pay the government, they are not happy.
Yeah.
I mean, but so it is a very personal.
Yeah.
It's a very personal thing.
Yep. Paul bring up a very good point, and that is most people in their mind think taxes, that's not a planning matter. That's not a personal matter. That's a numbers thing. That's it's a necessary evil. You just got to do it. And you put it overall in the context of everything else, and it's worth money. It's worth dollars and cents. It's also worth peace of mind. Very important.
Yeah, absolutely. And that's because when we bring it in-house, when we bring it as part of the overall plan that we're talking about, we take that emotion, in a sense, out of it because people are scared. People live in fear.
Yep.
I have to pay the government, and if I have to pay the government this amount, then I may not be able to have that amount in my savings, which means I may not be able to retire, which means I may not be able to, which means and so people live in fear because of the unknown. And that's exactly the opposite of what a plan should do. The plan brings peace, right?
Right.
The freedom, not just freedom to give, serve, and enjoy life, but freedom from fear. Freedom from the unknown. So when we plan, that's where we start. And so for you, if you're watching, you're listening to this, and you're living in fear, whether it's because of taxes or because of insurance or legacy or income, whatever the reason is, give us a call. Let's start the process of putting together a plan to give you freedom. Freedom from fear, freedom to give, serve, and enjoy life. It starts with a very simple clarity conversation. Where are you at? What are your hopes? What are your dreams? What are your fears? And let's address them. What are the risks you face? That's where we come into play. Let's help you plan, put together a plan that mitigates those risks and takes them as far off the table as we possibly can in every area, including taxes. So give us a call. 816-246-WISE. Email us at info@wisewealth.com. That's the best way to start. And let's put together a simplified retirement plan for you that can give you that freedom. Thank you, Stephen.
Absolutely.
Thank you for putting together a team that addresses all these issues. And I know we look forward to the next time we're going to be talking about legacy and legacy planning and what does that look like and how you helped address that here at Wise Wealth within the team. Bringing Becca in has been a fantastic aspect to really help enhance the overall team experience and the relationship for our clients. And so thank you for putting that together. Thank you, Becca, for caring. I know that our clients feel that.
Yep.
And that really matters. Not planning is important, but caring is even more important.
That's right.
And our clients feel that. And so thank you for that. And again, thank you to you, our viewing and listening audience. If you're watching this, if you're hearing this on the podcast or watching it on YouTube, you're the reason we do this. We do this for you. If you found this information valuable, share it. Share it with your family and friends. Taxes is something that everyone deals with, and so you should be able to find someone to share this with. If you haven't subscribed yet, click that button below, because that's going to let you know every time a new episode comes out. It just makes it easier to find. It also makes it easier to share this information with others. And so, again, thank you all. Thank you for watching and tuning in, and we look forward to seeing you next time. Again, for all of us here at Wise Wealth and the Simplify Your Retirement Podcast, this is Paul Brock reminding you that financial peace comes from having a plan. We'll see you next time.